So I think I'll go ahead and get started. I'm Tom Simpson, and Cindy and Jeff, also from Ignite, are on the call here. But I've, over the last, last couple of weeks and couple of months, I feel a lot of questions about how the current environment has impacted market conditions, particularly for those who otherwise might have been interested in selling their company or looking to buy a business. So I thought I would take that interest and invite Meridian to give us an update on how they're seeing things in this COVID-19 world. So we've got Brian Murphy, who is president of Meridian, and Bruce, who's a managing director with Meridian, on the call today to basically give us an update. And Meridian is a top Seattle-based investment banking firm, been around since 1995, completed well over or nearly 250 transactions, including many for Spokane-based companies. Most recently was the sale of Berg Manufacturing to HDT. And then before that, the sale of a majority interest in Tedder Industries to Main Street Capital. And there's several other transactions that they've worked on here in Spokane. And I've been fortunate to be involved in a couple of those. And in each case, they've just done a top-notch job. So I thought they'd be a great choice of a firm to provide this update. So with that, Brian and Bruce, I'm going to turn it over to you, and hopefully, and I know you've got a prepared presentation, but I would encourage people that if they have questions, just to raise your hand or unmute yourself and do it in an appropriate manner so that we can have an efficient dialogue throughout the presentation. And we'll also have time for questions at the end. So with that, I'll just turn it over to you, Brian.
Great, appreciate it, Tom, and excited to get the invitation and glad to be able to be part of today's discussion. As Tom said, please don't let me talk for just 20 to 30 minutes consecutively in a monologue. I usually, the pros and cons of a webinar is you can talk to a lot of people, but you also see your participation count dwindle as you get later in your presentation. So there's a real-time tracker, so please don't hesitate to reach out with questions. I will pull up the slides and generally refer to them. But again, stop me at any point. The discussion topics I really tried to break down into two sections. One, or the first of which is, what have we seen in the capital markets since about March 15th? And it feels like it's already been a 2 or 3 year cycle in the last 60 to 75 days. And then we'll move into, okay, based on what we're seeing in the capital markets, what are some of the conversations we are having with our clients or potential clients about ways they can leverage some of the dynamics within the capital markets on different use cases or opportunities that we're seeing. So I'll move more to use cases and things we're seeing more, what I call proactive management teams or business owners pursue. Really quick, so I'll set up a screen share here. Did that pop up for everybody?
Yep.
Great. So to give a perspective, give our perspective, I don't know why this isn't shifting. One second, it won't let me shift my screen here. Okay, there we go. So to give you a quick perspective on where we're coming from, Meridian focuses on the private, lower and middle market of the capital markets universe. For us, that means companies generally between, call it 10 and $500 million in enterprise value. So these are the conversations we're having with business owners, investors in that space, lenders in that space. I think often when people think capital markets, they use public markets or the stock markets to determine what's going on in the investor community. And the fact of the matter is, particularly in times of crisis like this, given the difference in liquidity, the difference in availability of capital for different size companies, and just the overall availability of information and future outlooks for the large public companies, the private markets react very differently. And so those are the conversations that we have and will be speaking to today. Additionally, at Meridian, we focus on we have an industry coverage model. So we focus on really 7 core industries, all aligned within, generally speaking, family businesses. So you'll see we have the benefit over the last 75 days of probably having 400 to 500 conversations with business owners across a variety of industries, whether it's aerospace and defense, consumer, technology, diversified industrials. And hopefully those insights give us a variety of perspectives and to be able to see the common themes of feedback. And then also certainly the impact to capital markets has not been felt equally across industries. Telecommunications and technologies have almost become in more demand and are demanding increased premiums in today's world. And then obviously, to use maybe some of the more difficult examples, if you're in travel or commercial aerospace or restaurants, obviously the impacts and uncertainty are much more meaningful. So as I said, broke down the discussion into two main topics. First, I'll talk about what's going on in the capital markets today. And again, really tried to focus on what's gone on since March 15th. We've seen a significant slowdown in capital markets activity over the last 75 days. And what's driven that is, generally speaking, and this likely doesn't come as a surprise, is private investors do not respond well to times of uncertainty or performance volatility in the companies they're investing in. And needless to say, the rapid pace at which the market went from near record levels in consumer confidence and business confidence to some of the most profound uncertainty, at least in the last several decades, essentially put a full halt to a lot of the investing. A significant portion of that halt or slowdown was caused by the M&A markets, particularly in private business and particularly for private equity transactions, are driven by non-bank cash flow lenders. So these private credit funds, mezzanine funds, business development companies, you may have heard of some of these trends, but these aren't the Wells Fargo, B of A's, or Chases of the world that are lending on asset bases. These are lenders that are private credit facilities that are lending at more aggressive rates, more aggressive leverage multiples, and a higher cost of capital. And by definition, if those individuals aren't lending, it immediately impacts the valuation and ability to get transactions across the finish line. So what we saw is, starting on March 15th through about a couple weeks ago, we estimate about 60 to 75% of transactions in the market that were being pursued were put on hold indefinitely or for a minimum of 90 days, while investors and lenders tried to get more certainty and visibility on what the new normal will look like. Going on to the key stakeholders, this slide really speaks to the key stakeholders and the conversations we've been having. So businesses are the sellers. They've just experienced deep and widespread challenges, whether it's related to supply chain, sales, demand, liquidity, very difficult decisions between people retention and talent retention versus right-sizing companies, not knowing when things will normalize, makes those people decisions very difficult. And the immediate focus, instead of being on how do they bring on additional acquisitions or sell their business, went to stabilizing their business and pursuing emergency initiatives. PE firms and lenders, they rely equally on each other. So in a traditional lower or middle market transaction done by a private equity firm, 50% of the transaction is done with private equity capital, and approximately 50% of the transaction is done with debt from those non-traditional lenders. As I mentioned, those non-traditional lenders essentially went on a 30 to 60-day shutdown. I'd say about 5 to 10% of lenders remained active in the market starting on March 15th. And the reason for that is, again, by definition, M&A activity over the last 8 to 10 years has been heavily driven by the attractive debt markets. And so companies in these portfolios, even if they're performing well, have pretty meaningful debt loads. And those debt loads are not secured by assets in these deals, they're secured by cash flow. So when there is a shock to the cash flow on a heavily levered, or at least more than average levered business, the immediate need for these private equity firms and lenders is to focus on their internal portfolio. And so they were trying to get a read on where were they going to break covenants, where would they be underwater on their equity, what additional capital resources will be required in order to get back into covenant or save the business. And that focus basically had them shut down all new investment vehicles, at least up until a couple weeks ago. And then in terms of strategic investors, larger companies that are looking to make add-on acquisitions or acquire smaller entities for market share or competitive positioning. The public markets became much more focused on liquidity and how will core divisions of these large companies perform. And so they immediately started looking internally at their own portfolios of divisions, liquidity needs, and the idea of spending aggressively for acquisitions that were currently in market when they may need funds to retain certain employees, avoid layoffs or furloughs. At a minimum, from a public relations perspective, no one really wanted to be in market pursuing aggressive acquisitions while they were potentially needing to pursue layoffs, right sizing, or difficult decisions internally. So overall, a difficult environment, as you might expect, seeing some of the trends in the public markets. I'd say what's been positive is just in the last few weeks, we've seen a return to optimism in a few areas. So I'd say many companies, maybe 80%, particularly those that were better positioned and had healthier balance sheets, we've seen the business owners or management teams begin to reach out to us and ask questions like, well, we've seen a lot of disruption in our market. We never want to waste a good crisis. What things can we be doing as a better positioned company, whether it's accelerating growth initiatives, buy-side initiatives, what should we be thinking about, and how proactive should we be in leveraging the capital markets? Investors and lenders, the good news, I'd say about 50% of lenders, those non-traditional lenders I mentioned, are back and returning to market and looking at new deals and submitting term sheets on transactions, albeit at less attractive terms. I'd say cost of debt has gone up by about 100 to 200 basis points, which represents maybe between 8 and 15% on these deals. And instead of being able to leverage often 3.5 to 4 times EBITDA or earnings on transactions, that the amount of leverage available has come down probably about 20% as well. But still, that activity in the non-bank credit markets has allowed transaction and private equity firms to continue to come. And private equity firms is very interesting because right before the crisis was preceded by literally 8 straight years of record fundraising activity for venture capital and private equity firms. And by definition, these are firms that need to put money to work in a defined timeline, or they have to give the money back, or their model breaks down for those vintage years where they raise those funds. And so private equity firms have rapidly moved to creating more creative and flexible structures that they think meet the needs of business owners, today versus pre-COVID, and we'll get to what those are. And then additionally, the stimulus packages, and I know there's a variety of opinions on whether they're the right packages or stimulus, where the money was put to work, whether it was done efficiently, and certainly it created a lot of chaos. But overall, one thing the stimulus packages has done is, I think, provide a cushion or a bridge to returning to some normalcy, particularly in the credit and liquidity markets, whether it was the PPP programs, the disaster injury recovery program, and things like that. So given the stimulus packages and the return to activity, we expect a few things to happen in the markets over the next 6 to 12 months. The days of rapid full sale, 100% sale transaction and majority recaps for people to get liquidity or sell out at record multiples, those probably come down over the next few months outside of a few industries I already mentioned. Defense, technology, certainly technology supporting remote learning or remote access or telecommuting, food, particularly to the grocery channel. Those industries will continue to do well and attract record premiums because there is still a record amount of capital pursuing what's a much smaller number of what I'll call attractive deals. And what I mean by that is deals with high levels of revenue certainty, continued growth profiles, and strong visibility in their industries. For the other industries that maybe weren't as resilient to the pandemic and uncertainty, we expect there to be a shift to minority structured transactions. So again, these are business owners that are looking out and saying, wow, based on what just happened, I know now is the time maybe for me to make some accelerated investments to pursue opportunities that have been created by the disruption or dislocation in this market. But it would sure be nice to have a partner, a capital partner, to pursue those opportunities. So perhaps I'll bring on a minority partner at 20 to 30%. Perhaps I'll bring on alternative debt functions to pursue an acquisition, to pursue a buyout out of another shareholder, whatever it might be. The cost of that capital will increase, but again, the opportunities that that capital can help create, many owners are looking at now as over the next 12 months as the most attractive time to take market share compared to the last 10 years. And so despite a slight increase in cost of capital, the return on that capital could certainly be viewed as attractive as ever in the last decade. We also think mezzanine financing will continue or will come back. Mezzanine has had a tough go the last 3 to 5 years because, again, as non-bank lenders, private funds, and business development companies that are essentially unregulated banks have seen just increased earnings and increased opportunities. That has squeezed out these mezzanine funds that charge higher interest rates on the back end of capital structures. Essentially, their capital was no longer needed in transactions. As the balance sheets, as several of these non-traditional lenders are being squeezed and struggling, we think we'll see a return of mezzanine capital as an attractive solution for investors and companies looking to fill the more challenging back end portions of their capital structures.
Hey, Brian, just for a clarification for the group, why don't you kind of summarize your definition of mezzanine capital?
Yeah, so at the highest level, I'd call it subordinated capital. So it'd be behind or subordinated debt. So debt that's behind those lenders that have a lien on your assets. Often it doesn't have a personal guarantee. And so it's really subordinated behind all debt, but ahead of all equity. And it tends to be somewhere between, if a senior lender will offer you somewhere maybe up to 2 to 2.5 times, maybe even 3 if you're a large company, EBITDA. So let's say you're a $5 million EBITDA business. A senior lender often will go out to 10 or 15 million, depending on your size and asset coverage. Mezzanine will go another turn or turn and a half beyond that. So they'll lend you dollars 15 million through 20 to 22 for an interest rate typically around, call it 11 to 14%, and a little bit of warrants or a small portion of equity on top of that. Another main difference is senior debt requires amortization in most cases. Mezzanine, you're interest only until a balloon payment on the principal, typically 5 to 6 years out.
Perfect, thank you.
You bet. So what does this mean for the capital and M&A markets overall? We actually think there'll be probably, again, a decline in full sales, which will bring down total transaction volume for a dollar amount. But in terms of activity, in terms of number of transactions, we think there'll be a return to activity in Q3, Q4, maybe Q1 last year, but the transactions will look very different. It'll be investors that have money to put to work looking to back solid companies solidly positioned in their industry with more minority and growth investment transactions. So with that said, what are some of the use cases or conversations we're having with business owners in terms of how to leverage the capital markets to pursue some of the opportunities that have been created? And really, this is a high-level slide of the conversation. Again, this is based on 400 or 500 conversations with business owners. The first 30 to 60 days of COVID, everyone was in phase 1, or not everyone, but 90% plus was in phase 1. How do I stabilize my business? What are my key risk areas and how do I address them immediately so I can stay afloat or retain my people? And just really trying to get a feel for what the revenue and cash flow demands of the business would be in the very near term. We are rapidly seeing a majority of businesses, at least those that we talk to, move into phase 2, which is I'm starting to get a feel for my new normal. It might not be at the level of where I was in 2019 or Q1 2020, but at least I have a level of visibility now and confidence in my demand and otherwise where I can return to thinking from a growth mindset or more offensive mindset. So we're having conversations with people saying, what type of capital do you want? What initiatives will you be using this capital to pursue? And based on that, what's the right capital alternative for you? And that gets us into these conversations where how can you leverage the capital markets to pursue, again, these opportunities created by COVID-19. And it really falls into 3 or 4 categories, which are certainly related in some respects. The first is, how do you just maintain or increase your balance sheet health? These are for companies that maybe aren't quite as well positioned from a liquidity standpoint. They used stimulus money to continue to, maintain cash flow in the near term. Obviously, that stimulus money will run out at some point, and they'll need capital to bridge themselves to a positive cash flow position or return to normalcy. From a more offensive or growth-oriented standpoint, items 2 through 4 items 2 through 4 are based on more offensive strategies. So the first is a recapitalization to accelerate a growth initiative, or to maybe realign shareholders that no longer have the same risk tolerance and profile going forward. Buy-side M&A, if you're well positioned in your market and some of your competitors are struggling, there's obviously going to be opportunities for value-based M&A going forward, and often you'll need capital to pursue those. Going through each one of these quickly, I think probably the most interesting slide based on Tom's question is, what are the forms of capital available from a debt perspective to shore up your balance sheet? So these are solutions that really don't necessitate that you give up a meaningful portion of equity. So they allow you to keep full control. They don't often include board members that you need to add to your board. They tend to be more limited in the covenants compared to equity, and they come in a variety of pictures. The ABL loan you see in column 2 and the senior term loans, those are loans that you often get from your traditional lenders, the Wells Fargo, Chases, Washington Trust, Washington Federals of the world. I assume many of you are familiar with those. Where Meridian tends to come in, and in today's environment, we think there'll be more opportunity, is in the alternative debt world. So these are the debt worlds there. The Chase and the Wall Fed said, hey, we can't necessarily get you to where you need to go. Bridge financing is one. This tends to be very short-term loans, often in the 15 to 20% expense range. They're often for 6 to 12 months, but very light on covenants, very light on diligence requirements, and can typically be closed within 4 to 8 weeks. So this is something where if you can provide a picture to, you just need a bridge to keep people retained, or to get the approval from a regulator to execute on a growth initiative or return of order volume in a COVID-19 environment. Then on the right side of the page, probably the other one, as I mentioned, we'll be spending a lot of time in, is the subordinated debt and mezzanine. I already gave a profile of this, but what's attractive about subordinated debt and mezzanine is, again, if you already have a line of credit or an ABL loan that has you out to say 2 to 2.5 times EBITDA, this is an opportunity to get access to another turn to turn and a half of funds for growth initiatives that is at a high cost of capital in terms of percent interest rate, again, 11 to 13%, but a low cost of capital in terms of fixed coverage ratio. Since you have no interest payments, the cost of these loans on a, say, $5 million, $10 million loan at 10% is $500,000 to $1 million a year. And after writing off the interest expense, you're often only at 60 to 70% of that. And so the amount of cash flow required to bring in that level of capital to pursue an acquisition, a buyout of a minority shareholder, with maximum flexibility is where a mezzanine or subordinate debt solution would come into play. Where do we see these loans being used? So the business strategy supported. Again, several shareholders, I think, have said, you know, I just saw my business value go from being worth, pick numbers, 40 million to 20 million in the current environment. So it no longer makes sense for me to pursue a full sale because I have confidence that my business will return to a 40 to $50 million valuation over the next 2, 3, 4 years. That said, the crisis also made me wish that I'd put at least a portion of my nest egg away before pursuing a 2 to 5 year growth strategy to return to those pre-COVID-19 levels. So things that the capital markets can provide is access to a nest egg or partial liquidity to shareholders while retaining a majority of their business. We also see in generational family businesses scenarios where one generation of the family has a different risk appetite than another, or even a non-family business where there's a minority shareholder who's maybe seeking liquidity or doesn't have the same confidence in the growth profile of a business compared to the other majority shareholders. It can often be difficult to buy out those shareholders unless they're willing to accept a seller's note. You know, traditional banks often don't like supporting what I'll call fair market value shareholder buyouts. And so the capital markets, we're having a lot of conversations buying out 20, 30, 40% shareholders, using sub-debt, using minority equity to, again, align the shareholders to those that want to pursue a growth strategy over the next few years. What's attractive about a lot of these strategies is it provides access to capital to pursue growth initiatives, but it also lets you retain your control of the business. So if you're taking mezzanine debt or a structured minority solution, you're retaining a majority of the equity upside in the business, and you're maintaining control rights in a variety of initiatives. The things to consider when looking at these options is, when do you need the capital? How much of the capital do you need? And when do you think you'll have the funds to pay it back? And depending on the answers to those questions, you know, we often speak to clients and say, here's your solutions, here's the cost of capital, and here's the risk profile of that capital based on when you think you'll be available to pay it back. You're capitalizing on record dry powder in the market if you pursue this. When I say dry powder, that's capital with private equity firms and lenders in the market. So again, by definition, these lenders are trying to put money to work. So I'd say there's about 3,000 private equity firms in the US. As of March 15th, probably about 20% of those funds would be willing to consider a minority transaction. Today, it's closer to 40% because these funds know that this is the best solution. Business owners don't want to sell in today's market at reduced values for something they've put a lifetime of work into, but they may be open to pursuing a minority transaction that would allow them to grow the majority portion of the business that they retain at accelerated rates. Things to consider is the covenants for minority requirements have tightened. So when you have a lot of typical majority investors moving into minority markets, the way they think about covenants and controls and veto rights, those have tightened and become more strict compared to 90 days ago. But again, those can be resolved on a case-by-case basis.
Brian, who are, you know, it's easy to identify traditional sources of senior capital, banks. In my world, it's easy to identify venture capital funds, but you know, how does the average, you know, private company CEO or board learn who these sub-debt or mezzanine firms are? Are they insurance companies? Are they branches of private equity firms? Or are they just entities that are just set up to provide sub-debt or mezzanine capital?
All of the above. So, I mean, if people are familiar with the concept of private equity firms, alternative debt providers are the same thing. They raise funds or create sidecar funds from insurance companies, from wealthy individuals, from pension funds, from universities. And instead of the fund being designed to invest equity, the fund's designed to invest different layers of debt on the balance sheet. So the best way to, mezzanine funds are probably the most difficult source of capital to identify, but there's hundreds out there. You can find, you know, 10% of them via Google search, but probably the best way to look is if you're familiar with industry competitors in your space that have been invested in, do some research on that transaction announcement, and you'd get a feel for the mezzanine funds that are most active in your specific industry. Another easy and free way to do it is, you know, ask an investment bank like Meridian. I mean, it's not a secret, but investment banks do a lot of free work without engagement to demonstrate kind of the value they can bring. So if you have a relationship with a Meridian Capital or one of our competitors, we have access to databases, which gives us lists. I mean, these are paid databases we have access to. They give us a list of private equity firms, and we break them down by industry based on our interactions with them. And so it's pretty easy to reach out to a private equity, or sorry, an investment bank and collect a list of the 20 to 30 most active subordinated lenders in your specific industry.
Okay, perfect, thank you.
So, you know, this graph in its it's not necessarily webinar friendly, so I'll send out this report afterwards. But this graph shows some of the merits of why someone would be interested in pursuing a minority transaction. Again, many shareholders we're talking to believe that they can take more market share over the next 12 months than they've been able to take over the last 5 years, just based on the dynamics in their respective industry. So they're making a bet by bringing on a partner today at a reduced valuation. Will make the 60% ownership they retain worth more than it otherwise would have been if they kept 100% of the business for a 5-year cycle. And so in this, starting from the left-hand side of the page, you have a business that says, you know, the existing shareholder group owns 100% of the business, but in exchange for cash from a private equity firm or a subordinated lender used to buy on an existing shareholder, support an organic growth initiative, or support M&A activities, you will be able to accelerate the enterprise value of your business. And if you look at the full right-hand side, if you're able to double or triple the size of your business while only selling a minority portion, obviously you have a capital partner to help you with the risk share as you pursue those growth initiatives, and you're making a bet that your growth will offset the portion of the business you sold at a theoretically reduced value in a unique market like we're in today. Another very interesting aspect to minority equity is valuation often matters a whole lot less. And what I mean by that is there's ways if you believe in the growth of your business, to structure what's called structured minority. A lot of minority investors are not necessarily interested in just having common equity ownership going forward for 20-30% of your business. So they'll come in and say, we'll offer you a much higher value if you give us a liquidation preference or a preferred return on that capital. And so structured equity often comes with preferred return of maybe 8 to 10% per year. Or they'll say we get our money back first, or maybe we get our money back with a 2 times return before the common shareholders begin to return on their capital. But the reason that is attractive is there could be a scenario where you're very confident in returning your business to pre-COVID levels or even beyond if you have access to capital today. So if someone's willing to come in and you're saying, well, I want you to have common equity and share it with me, they might only be willing to offer you, on a $20 million valuation, they say, we'll offer you $6 million and a $20 million valuation if you're only willing to give us common equity on a pari passu basis as us going forward. But if you say, we'll give you first money out, or we'll give you 10% preferred return, they'll come in and say, well, we'll give you that $6 million maybe at a $35 million valuation because you're helping us protect our downside. And so obviously if the business does in fact build to $35 million or more, the amount of equity you retain can be often double, even triple as much if you're open to structured scenarios. So that's another thing to consider when thinking about minority. Minority investments are much more often done with preferred and common structures compared to majority. And as a result, valuations matter a lot less and structures matter a whole lot more. And so again, this would be another scenario where if you wanted to know what typical structures are and how to measure the cost of capital and the pros and cons of each, that is free work that most any investment bank would be willing to do for you, kind of with no commitment on the back end. I'll stop it. That's a bit of a foreign concept for many people. So I know, Tom, many in your group are in the venture financing world, which also has the many tranches of capital and structure. But I guess I'll stop there to see if there's any questions related to that structured equity piece.
Feel free to unmute yourself if you have a question.
Okay, moving on to.
I mean, that's a mechanic or a structure that, as you know, is very common in the venture world, probably without the implicit highlighting of the delta in valuations, though.
Yeah. I mean, we've seen. Yeah, I mean, as you know, Tom, if you gave us ultimate creativity on the structure, we could make a $50 million valuation that's less attractive than a $25 million valuation on a minority deal. And so it's just, it's very important not to fall in love with the sticker price when you're thinking about a minority equity partner.
Yep. You know, just one, I mean, you know, this information is really fascinating. But how do you, other than just being in the market with companies and specific transactions, how do you glean all this intelligence? Do you actually have people in your firm that are just kind of regularly staying in touch with, you know, private equity sources, mezzanine funds, and sub-debt funds just to get up to speed with what they're looking for, absent working on a specific transaction?
Yes, and that's where the industry focus we have, we think, can be an advantage. So the responsibility of each one of our industry team leads, which are dedicated, you know, personnel, is to keep a pulse on the most active and acquisitive investors in each one of their respective verticals. And so not only do we break it out by types of capital, but further, we want to be having conversations with each bucket of capital providers that is focused on a particular industry, and ask them about what they're seeing in the market, what trends drives value for them. So what levers can our clients pull to become more attractive in the market or drive higher value? And then of course, what terms are they seeing? And you know, it's an information share. In order for them to see transaction volume from us, they want to be helpful, and vice versa. In order for us to get a good audience with them, we want to be helpful in sharing what we're seeing in the market. So I'd say we have KPIs we track on this, but again, our database we have at Meridian includes about 1,800 private equity firms and sub-debt lenders, and we are required to talk to them or interact with them at least once a quarter to, you know, get updates on, you know, trends, investment focus, items like that. And again, there's services that do it on a broad level, Capital IQ, and why am I blanking on the name? Capital IQ and PitchBook, the Seattle-based company that has done such a good job in this area, but they're obviously doing it in broad swaths. Again, talking to an investment bank, I think, can be valuable in getting the specific trends in your industry, and it's free. The last item I've spoken to this, but one of the areas, again, naturally when it comes to M&A, why would you raise capital in today's market? Well, one obvious alternative is to pursue buy-side M&A. There will be distressed companies in market. There will be companies that have shareholders that maybe don't have the appetite to engage in a turnaround of their business, and that will create opportunistic or attractive buy-side opportunities. But again, given the amount of dry powder in the space and the number of investors gearing up to pursue this alternative, we are encouraging people, if they think buy-side M&A could be an attractive alternative for them, they should start conversations now, not necessarily with the people they want to invest in, but with the potential capital sources that may be required for them to complete that acquisition. Because if you try to, in parallel, run a capital raise process in addition to a buy-side M&A process, you're setting yourself up for a really challenging 3 to 6 month window where you, and you're not positioning yourself as the most competitive investor or a buyer in that situation. To be positioned as a strong buyer, you obviously want your capital solutions teed up so you can go to people and say, I know what my cost of capital is, I know where I can get access to capital, here's why I'm an attractive buyer. And so we're encouraging people that if they want to pursue an acquisitive buy-side strategy, now is the time to think about cost of capital, who those capital partners might be, how much capital you think you'll need to pursue those alternatives, just so you're better prepared when that buy-side M&A might actually happen, and particularly if you're going to be competing against someone else in that process, which again is likely given the amount of dry powder in the space. So again, won't go into the benefits of buy-side M&A. I've mentioned that throughout, but I do think the benefits of preparing early, even if you don't have something right there in front of you, is a good use of time.
Earlier, you referenced value-based M&A. How does that compare with buy-side M&A, or is it a form of buy-side M&A?
No, it's a form of buy-side M&A. So, and I'm not sure I have a specific definition other than if you feel like you got a good price. But I mean, obviously, the best way to do is there's just like mutual funds, there's growth-focused and value-focused mutual funds,
Yep.
and there's growth-focused and values-based private equity firms. You can be a growth-focused or value-based buy-side investor as a private company. And obviously, they're not mutually exclusive in all cases, but in this market, there's going to be more distressed sales, which likely means more challenging integrations and more creative structures.
Yep.
But also they could be at attractive values.
So in the public markets, kind of a reference point for value investing is Berkshire Hathaway and Warren Buffett. And he really hasn't jumped in yet. And he says his phone's not ringing. In the private markets, are the value, are the funds that are providing capital for value-based M&A, are they pouncing now, or are they waiting, which might imply that we have, more downside turbulence ahead of us?
So I'd say the funds are circling and pouncing. I mean, so we're getting more calls than we can field from private equity funds saying, hey, we're still investing and we're looking for XYZ. And XYZ is a really good business that's selling at a value. So,
Yep.
Which, is not very helpful. So they're ready and the capital's available and they're shifting their focus. As I said, many saying we'll do minority structured deals now versus majority. And we have a lot of money to put to work to do that. What has not happened yet is the sellers on the side being ready to start pursuing those processes. I mean, other than case by case. So we think it's happening soon in the next 60 to 90 days, because we've seen the trends and conversations with business owners go from triage to, wow, I think there's some interesting opportunities. Can you do some analysis for me on X, Y, and Z? And naturally the next step would be people looking to pull the trigger on some of these scenarios. But certainly we haven't seen the transaction activity happen yet. And that's why early on I said we expect that to happen more in Q3, Q4 versus Q2.
Okay.
And really at a high level, those were the key topics I wanted to cover. So I think I went for about 30, 40 minutes, so I apologize for that, but happy to open it up to any questions from the group.
Okay,
Brian?
group, I've been asking all the questions. It's your turn now.
Brian, this is Katrina Rogers. I've got a question for you. Early on, you talked about companies working on de-risking strategies. What kinds of de-risking strategies are you advising your partner companies on?
In terms from a finance perspective or generally speaking?
Well, I would say you kind of covered quite a bit of the finance perspective.
Yeah.
I would say more generally, thinking about all the weaknesses we've uncovered in supply chains, as well as, maybe people being a little over leveraged.
Yeah, so I think, strategies we're seeing groups pursue, so a lot of it has to do with what I'll call talent retention. And I think we're seeing a lot of businesses struggle with, I've already made and this sounds more curt or crude than I intended, like the easy cuts, often the first 5 to 8%. But we're getting to the point where we're going to need to make some really difficult decisions about people that we have a lot invested in and are good resources. And so we are having conversations, whether it's work share programs, the benefits of furlough versus full layoffs, staggered or hybrid shifts. But particularly the work share is a de-risk strategy that we're seeing a lot of manufacturers use, where they can cut to 60% essentially pay rate or hours. The remaining 40% is subsidized by the state, at least partially subsidized. And so they're able to retain a much greater percentage of their workforce for a bridge period, at least through the end of the year, with the hopes that they'll be in position to hire them back. So I'd say one de-risk strategy is, how do you look at creative solutions to retain your talent in hopes that things return to some kind of normal in the next 6 months? Certainly, de-risk, we view it more from a governance perspective, and it's related to finance, but aligning your shareholder group. So we saw this in 2008 to 2010. Often shareholder groups with multiple shareholders, whether it's generational, whether it's some are passive, some are in the business, have different views on how much time and energy they want to put into recovering to pre-COVID levels. And so what type of incentive agreements, shareholder buyout structures, governance agreements can you put in place that make sure that the key stakeholders of your group are aligned and rowing in the same direction? Because in environments like this, we see alignment often falls apart, when your equity value got halved in some cases. I'm trying to think about the supply chain. We're seeing a lot of companies leverage PPE to build up cushion in their inventory, knowing that their supply chain could have weakness or delays over the next 6 to 12 months, particularly if it's an international supply chain. So that takes capital, but it's de-risking by obviously being able to continue to hit your order. So we're seeing a lot around working capital. We're seeing AR terms extend. Large public companies who can do so, because there's not a lot a small supplier can do, are extending terms without necessarily asking. And then simultaneously demanding delivery times that continue to be, best in class. So you need more inventory with slower collection AR. So we're seeing a lot of net working capital modeling. And so we're modeling various scenarios for companies and saying, scenario 1, 2, and 3, what are the decision points and milestones we need to make? And we need to be in position to make those decisions when that milestone occurs. Bruce, what am I missing? Those are probably the main ones that popped to mind. To the extent that's helpful.
No, I don't think you're missing any. It's a subtle point, but some of the strategic analysis that's going on causes people to look really at the fundamentals of their business and see if there are adjustments that can be made that are going to take up some of the risk that they've had, and may also, in turn, longer term represent opportunities. We've talked to a company, for example, that what its core business really is, and there are parallel kinds of operations that can be done that enable it to expand without having to acquire additional expertise in what they're doing. So they can somehow diversify to a limited extent, take off some of the risk that they've had, and really not have to extend themselves.
Thank you, gentlemen. It seems to me that some of these gaps or these risks that have been identified present potentially some really good opportunities for maybe some new businesses. Are you seeing any of that?
Yeah, I mean, we focus less on new business. I mean, we've certainly seen plenty of PPE or gap financing solutions. What we're seeing a lot of is less about new business, but more new business divisions from established businesses. I think in particular, companies with stronger balance sheets are aggressively trying to leverage their smaller competitors that don't have as strong a balance sheets to maybe offer competitive pricing on contracts in order to take them over. You see a lot of manufacturers that were subbing out work on a tier 2 basis, bringing that work in, and then having the ability to acquire that business that they just brought the work in from. And so some of these strategies, are built to capture market share in a down market. And then certainly from a services standpoint, our business services practice, whether it's financial services, technology services, SaaS, we see a lot of companies with strong technology platforms rapidly trying to put that technology to use for cybersecurity, remote learning, telecommuting, whatever. I mean, all the things that are on trend. So leveraging their software development teams, or what used to be a adjacent or tangential service offering opportunity, now they've moved to the forefront given what they expect to be a 2 to 5 year trend.
You certainly see that a lot in the healthcare area. In the broadest term, they call it e-health, and they look at telehealth kinds of things and so forth. And there are a lot of companies that are trying to get into this, some either expanding what they're doing, and there's some important startups in that as well. So,
other questions?
Dan, I think that's what you do, right?
It is. Yep, absolutely. So we may be a little bit early for what you guys are offering, but very interesting service that you guys provide. Some interesting markers in our space right now. I was at a doctor yesterday, and they were all, a month ago, everybody was teed up on e-health and using, their teledoc services. And these guys want to touch and feel their patients. So it'll be interesting to see how some of that actually, holds on as the market changes.
Absolutely.
Brian and Bruce, in the remaining minutes here, it might be informative for this group to kind of have you just touch on a couple of the local transactions you've done. I referenced, most recently Berg, and then before that, what you did for Tedder. And this might be interesting just to kind of highlight your role in both of those transactions.
Sure. So on Berg, it was a very, I'd say, Meridian relationship and transaction. And that, as I said, we often have long-term relationships with our clients because we were founded by, maybe I mentioned this to you, Tom, at the beginning of the call before everyone got on. But we were founded in 1995 by former operators under the premise that when you're a sub $500 million or sub $100 million business and an entrepreneur, family, founder owned, which is a majority of our clients, a lot more goes into a transaction, particularly on the sell side. Beyond just the numbers. I mean, there's an emotional toll. There's getting the right partner that'll be a steward for your legacy going forward. What's your role going forward in the business? Things like that. Meridian was built by operators that had gone through that themselves, sold businesses, run businesses for private equity firms post-sale, and learned a lot of lessons. So as a result, we tend to get involved with clients 2, 3, 4, 5 years before we actually go to market, just to share ideas, be a sounding board, and discuss some of the things I've mentioned today. Berg was just that. We probably met Andy and Don and the team out there 4 or 5 years ago. They were approached, often in the market as a leader in the market with ideas or acquisition or sell side opportunities. But as it became clear that they were well positioned in the market and looking for a transition themselves, starting about a year and a half ago, they received a very serious unsolicited offer from one of their main competitors, brought us in to review that offer and then run a quick process to help vet that offer and try to strengthen it and increase certainty of close. So we were able to run a process, bring in, I think we received 4 or 5 ultimate bidders for that, one of which was the group that provided the unsolicited bid that fell apart, a year prior. Ultimately, HDT was the buyer, a private equity-backed, large $500 million competitor in their space. And I think our process of bringing in additional bidders, helping move the process forward in terms of helping with financing solutions and giving Don and Andy the comfort that they were getting, the best available deal in the market was really the value we provided there. In the case of Tedder, a little bit different. For those that know Tedder, a very fast-growing, innovative, direct-to-consumer business in kind of the personal security space. They make holsters and related products. We're growing very quickly online, very strong margins. We're vertically integrating, and we're getting to a size and scale where they were just getting some interest in the market and reaching a size and scale where their founder, in order to continue to accelerate, didn't necessarily feel like he was still the right person to push the business from a $20 to $50 million revenue to a $50 to $100 million revenue business. He thought a partner would help with that. And also the business had grown so fast that providing some liquidity for himself instead of owning all the risk going forward was important. And so we ran a process to a variety of private equity firms and strategic investors in that space. I think in that case, we got 15 or so initial investments, ultimately narrowed it down to a few private equity groups that would support a majority recapitalization that would provide Thomas Tedder, the owner of that business, continued upside in the business and minority ownership, but would come in and help him, facilitate continued growth, acquisitions, build out of the team, so on and so forth. And that business has been very interesting because I think overall personal security and gun sales were declining up until about COVID, and now direct to consumer kind of security sales. I mean, it's been a rapid increase, and they've launched a couple new lines for the female market and otherwise. And again, Thomas is still involved in that business and owns a pretty meaningful minority percentage. So.
Good. Well, those were both very successful outcomes, and I know the principals of those businesses were pleased with the process and the end result. So, one thing you've mentioned a couple of times, and that is that companies should feel free to leverage the resources of investment banking firms like yours. As a former investment banker myself, I kind of know what that means, but you might want to kind of highlight, and I certainly don't want you to be taken advantage of, but, as part of your getting to know a company, 3 or 5 years before actual transaction, you do provide a lot of market intelligence, comparable company analysis, ideas on structure. Maybe the remaining minute or two here, just kind of highlight, really how that is a real value added pre-service that firms like yours provide.
I mean, we maybe selfishly believe it's important for business owners to know what their competitors are doing, how their competitors are being financed, what transactions are going on in the market, and maybe most importantly, how is the market, how are the capital markets valuing factors within their business. So where can they grow that will increase shareholder value by the most and investment interest the most in the business, regardless of whether or not you're interested in selling or you think you're interested in selling in the near term. We think it's a very helpful insights to know how your market's growing and what the competitors are doing in order to make strategic decisions about what direction you want to go. And so, as you say, we spend a lot of time, since we're constantly speaking to investors in the space. We constantly have transactions in the space that, at least in the industries where you participate in. And so if you're an aerospace company, as an example, and you said, Brian, once a year, we'd like an update on how you think we're valued. What are the key valuation drivers going on in our industry? Who are the key investors? How long you think the strong buying trend will go on in our space, or whether you think it'll soften. And what mistakes have you seen, in terms of some of your clients prepping for market make, and what have the buyers cared about? We continually package those materials, particularly in the industries we focus. And we're happy to provide those materials to companies. We're happy to present to them. We often are asked to come, be a guest speaker at a board meeting, just to update the board on some of the dynamics we're seeing in the space to do that. And to the extent people want more robust, cash flow analysis help or formal valuations they can use, we can do those as well. More on it. I mean, those tend to move to a more temporary engagement basis, but everything I mentioned before that, we tend to do just to demonstrate how we think and to build relationships so we can be a trusted partner if and when an opportunity presents itself.
And in addition to getting, kind of key market intelligence, it's also very helpful for a company that thinks that they might be doing a transaction in the future to develop a relationship with the investment banker and ascertain that there's a good fit. And so it's a great kind of way to kind of try before you buy as well. So I've been on both sides of the equation, and I think a lot of companies don't really necessarily recognize the resources that a firm like yours can have as it comes to bear on, capital formation or mergers and acquisitions. So,
great.
Well, we're at 1
that.
o'clock. I don't know if anybody else has one last question before we sign off here. We will follow up with the presentation materials to everybody, and ideally, Bruce and Brian will be in Spokane regularly, maybe 3 or 4 times a year, and we'll try to get some small group gatherings and get a chance for everybody to get to meet them face to face.
So I guess just a quick question. So in the world of M&A, so if somebody like ourselves is vetting, an opportunity in the market, you guys like to lean in on those and provide some feedback and under a relationship, so not just loaning them money, but looking at deals.
Correct. I mean, we are primarily an advisor. We're not actually investing with our balance sheet. So if any question you have related to buying, selling, structuring a transaction or raising growth capital, we can often be of help. And at a minimum, I think we can be a good sounding board, or if it's not down the middle of our focus, we can point you in the right direction, since we're in the community, for lack of a better term.
Okay, great. Thanks.
Anybody else have any last parting comments or questions for Brian and Bruce?
I can tell you that we are looking forward to getting over to Spokane again, though.
Yes.
That would be nice.
I think we're all looking forward to getting out. So
Yes.
Absolutely.
hopefully you'll be over here soon.
Me too.
Agreed. Well, thanks
Well,
for
thank
setting
you.
it up. Enjoyed it. Thanks, everybody.
That was
Thanks,
great
Scott.
information. Appreciate it.
Bye now.
Thank you.